Japanification secured for the U.S., zero interest rate policy or ZIRP for forever. So as scary and as silly as that sounds with financial repression and zero interest rates for forever, we actually had an academic on Friday, Noah Smith, who is a finance professor, actually write an entire Bloomberg article about the U.S. is heading to a future of zero interest rates for forever. And he says it's the obvious way to avert national bankruptcy as the country keeps piling on debt. So I will read some of the article. He's talking about the Congressional Budget Office has just released its projections for the U.S. federal budget during the next 30 years. The picture is one of steadily rising deficits. Federal government borrowing now amounts to about 4.2% of gross domestic product each year. By 2049, the CBO predicts that will be more than double to 8.7%. And they have a chart here that's saying there's no catching up. It's going to get worse. Only a small portion of these deficits will be due to tax cuts. The CBO projection expects that individual income taxes rise substantially as a share of GDP. Wow, so they're expecting individual income taxes to rise substantially, nor will it be due to government profligacy. CBO predicts that discretionary spending will shrink substantially relative to the size of the economy. So instead, the growth in deficits is mostly about two things. First, government healthcare spending is projected to grow, which is partly due to population aging and partly because the CBO predicts that medical costs will keep going up. Yeah, because there is no competition, there is no free market forces. Second, and capitalism gets blamed for all the healthcare problems. Second, and even more importantly, the CBO predicts that interest rates will rise, forcing the government to spend much more on simply paying interest on its debt. The federal government now pays an average of 2.4% to borrow. In 3 decades, the CBO predicts that this will rise to 4.2%. If true, that will cause an exponential increase in the amount the government has to pay for debt service. Remember, I did a video on this a couple months ago. I spent about 4 or 5 hours doing the video with 4 different software programs at how fast is the U.S. national debt growing. I'll put a link to it at the end of this live stream show afterwards if you want to take a look. There's a graph on the burden of debt, federal net interest payments as share of GDP. So it really starts to get crazy every 10 years. So 10 years from now, another 10 years, it just gets crazier. So by 2040s, the CBO projects the primary budget deficit, the gap between non-interest spending and tax revenue, will stabilize at less than 4% of GDP, but net interest will keep on rising. And this is the danger with debt. Negative compounding. Interest payments on debt keep increasing, even though the interest rates are not necessarily increasing, because the debt keeps growing in size. This is because of the government borrows more and more to cover its interest payments. The amount of debt that's accruing, interest goes up, aka Japanification. In many ways, this is actually a very conservative forecast. The CBO assumes that the U.S. will raise taxes instead of cutting them, as it has done repeatedly. It assumes no future recessions requiring large increases in the level of federal debt for stimulus purposes. And most importantly, it assumes no big future increases in discretionary spending and no new big entitlements. If Medicare for All or the Green New Deal ever make it through Congress, the projected federal debt will be much, much higher. Well, that's where MMT is supposed to come in, right? It's supposed to save us. You know I'm being sarcastic, right? I'm having a beer right now. I didn't have a beer during the interview with Chris Irons at QTR. I'm having a beer now after I lifted and after dinner. So why is this a problem? If the government decides to cut deficits by raising taxes even more than the CBO predicts, it could slow the economy. If it decides to let the debt grow, it will have to borrow more and more in order to cover its increasing interest. So basically, it's trapped. The central bank is trapped, the government is trapped. And both borrowing, well, if the government decided to drastically cut and fire a bunch of federal employees, maybe, but there's like 0 chance of that. Having lived in the DC metro area now for almost 20 years, there's like 0% chance that there's going to be drastic cuts. They would rather basically collapse the dollar and reset than drastically cut the federal size of the federal government and cut government spending and entitlements and welfare and all that stuff. In fact, almost all the Democrats in the debates were all promising tens of trillions of more welfare and freebies, even to illegal immigrants, let alone the U.S. citizens, the Army military veterans who are suffering, who are in all these homeless towns in Seattle, San Francisco, L.A., San Diego, Orange County, California. Not a town, but the county. It's massive homeless population. A lot of veterans, unfortunately, who are not getting, medical care and all that stuff. If it decides to let the debt grow, it will have to borrow more and more in order to cover its increasing interest, and both borrowing and interest costs will snowball. That could provoke what the CBO calls a fiscal crisis, a private investor panic about the government's ability to repay its debt, causing a drop in bond prices that render financial institutions insolvent and causing an economic crisis. Not if you do financial repression, not if the government manipulates interest rates lower, not if it copies Japan, aka Japanification, which is what the European Union and the game plan for the European Union through the European Central Bank, all their bond purchases of corporate bonds and European government bonds, and it looks like the Fed is now on that path as the 10-year Treasury is down to 2%. The government thus, continuing with the article, the government thus has a good reason not to let debt spiral out of control. No, they have a good reason to manipulate interest rates. And the easiest way to keep that from happening is for the Federal Reserve to cut interest rates to zero and keep them there. As the government replaces its old higher, and keep them there? Oh, so you mean then plunge protection team to manipulate the rest of the interest rate curve? Because the Fed is only supposed to be able to control the short-term rate. They can invert the yield curve, try to invert the yield curve intentionally, but they're only supposed to be able to control the front end of the curve without market intervention and plunge protection team and stuff. No one should be controlling interest rates. The free market should, not 12 PhD economists who have a track record of getting things wrong all the time and abject failure, and then just printing and papering over the mistakes, like a little kid who won't pick up their own dog's dog shit, and they just put newspapers over it or they sweep it under the rug. As the government replaces its old higher interest debt with new lower interest debt, its yearly interest payments would go down until finally they dwindle to nothing at all. So he's trying to put a positive spin on financial repression. And I got something for you guys. I got a clip. I'm only going to play 26 seconds of it. This is a great interview. I highly recommend this interview. Go back and listen to it. I'm only going to play 26 seconds. This is from Carmen Reinhart from the September 14th, 2016 McIlvaney Weekly Commentary podcast. Must listen to. The interview is over an hour, but I'm only going to play 26 seconds. Some of the most pertinent stuff, talking about financial repression, manipulating interest rates, stealing savings, theft, what it really is. Oh, and why should you listen to Carmen Reinhart? Because she's a professor at Harvard, and she goes to the Fed meetings, and she gets to go to Jackson Hole, and she advises the Fed. So her and Ken Rogoff are main advisors. I think she's actually higher up the totem pole than Ken Rogoff is. And remember, Ken Rogoff wrote a book about the curse of cash and eventually banning money so government can go cashless society and start manipulating interest rates and start stealing from savers. So I'm going to play about 26 seconds of this clip really quick. Hopefully you can hear it.
Sometimes, if you find a more opaque way of picking somebody's pocket, you may get away with it for a while. I've had a very tough time with a lot of people convincing them that negative real rates are a tax, which to me seems something pretty straightforward, but because it is opaque, because it is not affected through the usual channels in which you're taxed, there is quite a bit of scope for pickpocketing.
And there's a lot of other good stuff, a lot of juicy tidbits in that interview. Again, I recommend listening to the whole thing at least once if you have not already done so. David McIlvaney does a fantastic job, and that was one of his best ever guests. I'm not sure if she'll ever come back on, but she admitted at the end of the interview that if financial repression, manipulating interest rates, stealing savings is implemented in the U.S., she feared for her own children and their ability to have a decent standard of living. She actually admitted that. And she is a person that actually advises the Fed. So for her to concede that at the end was pretty crazy. But at least she was being honest. Probably one of the few times that someone in power like that will be honest. Once in a while, we have someone like Lael Brainerd who's trying to move up politically or move up at the Fed, and she'll drop some truth bombs inside the Fed there. Telegraphing that the Fed didn't care about an inverted yield curve, that they wanted an inverted yield curve, which is a precursor to financial repression and manipulating interest rates lower and lower and lower, like Japan. So that's why I'm saying it's Japanification. Some of the other worrying things I have in my notes. Okay, LIBOR, London Interbank Operating Rate, which the big banks manipulated and got fined billions of dollars for. That has, last week, according to an article from Jeffrey Snyder, the guy who's on Macro Voices a lot, Eurodollar University, brilliant guy, a Eurodollar expert. He just said, he wrote an article that last week, for the first time since February 2008, the LIBOR curve inverted too. So the 3-month LIBOR has been on the move downward for some time. The 1-month rate has been gentler in its slope. Last Thursday, and the article was written this Wednesday on June 26th, the two finally crossed. As unnatural as inversion in the U.S. Treasury curve or elsewhere, it's another sign of imminent rate cuts. And then he is somewhat reluctant to point out how it was on August 9th, 2007, when the same thing happened for the first time last time around. So not too long after that, we had the 2008 financial crisis with LIBOR going inverted. So we have LIBOR inverted again. On top of that, there is 60% of the U.S. yield curve is now inverted. That percentage is so high, the last time it was around those levels in the 50 to 60% range, guess when it was? It was 1999 and 2005. Those were the last two times. And the 10-year U.S. Treasury is down at 2%. So they are picking our pocket. Savers are getting screwed. And this is why money is going into Bitcoin. This is why money is going into gold. This is why money is going into gold stocks. Because people are realizing that the governments, the main governments, like your European Union with the European Central Bank, Japan has been doing this longer than anyone else for 25 years or so, maybe even 30 years approximately. They've been doing this. The reason Japan has gotten away with this is, number one, they were the only country doing this for a very long time. Now you have other major countries trying to do the same thing. And Ben Bernanke lied to us. He promised Milton Friedman, too, before he died, that he would do everything possible to avoid the U.S. becoming Japan. And guess what? We're still on our way there, and we're going to have even worse stagflation and taxes probably than Japan. And on top of that, with Danielle DiMartino Booth, she found out, because she worked at the Dallas Federal Reserve for 9 years, that the Federal Reserve, that Ben Bernanke, while he was still at the Fed, when he was colluding with the other major central bankers, that if the crisis with QE and TARP and bailouts got so bad, that worst case scenario, Bernanke after QE, and if it didn't work, Ben Bernanke then wanted to, this is a crazy part, he wanted to issue trillions of dollars in zero coupon bonds. So the U.S. Treasury already issues some zero coupon bonds. I don't know the exact amount offhand. I did not look it up. But for those of you who do not know what a zero coupon bond is, let me read it for you really quick on Investopedia. So a zero coupon bond is a debt security that doesn't pay interest, which is called a coupon, but is traded at a deep discount, rendering profit at maturity when the bond is redeemed for its full face value. So they're showing in calculations here how a bond investor would calculate an interest rate if he bought the bond way below discount, say at 84% of face value of the bond. Then he could calculate in the example here, they're showing what a 6% return. I don't know over the time period here, 6%, which if he buys a certain bond that's $25,000 bond at an 84% of face value, and he's looking for 6% interest per year, if he buys the bond at $20,991, he gets the equivalent of 6% interest per year. So basically issuing bonds at a discount to people who, if they held to maturity, would get the equivalency of interest payments, but without actually paying interest payments. So just basically straight up more financialization, more financial engineering. People can make money off this stuff, but it sounds very risky, and especially if the government is intentionally trying to devalue the currency, because then your real return is going to be bad. So even though your nominal return on that bond, even if you bought the bond at discount and you got like that calculated in the example there, it's not factoring in the real inflation rate, which it could be a lot higher than your return, your calculated return for your bond. So, and Japan doesn't officially have zero coupon bonds, but interest rates are so low and the bonds are hardly even traded. I think there's very little volume. Some days the Japanese government bonds, some of them don't even trade at all. They're like by appointment only. And that's starting to happen in the US too, some of it in the corporate bond market, not in treasuries yet. But in Japan, the interest payments are so low, Japan cannot even afford at this point a 1% increase in interest payments. That's how big Japanese debt is. So Japan was the only country doing this for many, many years, and that's how they got away with it, and they were able to export their monetary inflation and credit through the yen carry trade and other speculations out of Japan. So most of the inflation either went to buying bonds in Japan or it went to assets outside of Japan. And that's how they got rid of a lot of the stuff. But now you have all these governments doing it. And the other major reason is there's a lot of loyal collectivist Japanese people there. And if their government asks them for national security to buy government bonds and runs TV commercials and radio ads and has Japanese pop stars say that it's a good investment to buy bonds, even if it's not true, but it's just all marketing bullshit, then a lot of Japanese people for their savings will buy that. I hear that Japanese government bonds and real estate are two of the main investments in Japan. And also foreign stocks. A lot of Japanese do not trust Japanese stocks after the big Japanese stock bust like 25, 30 years ago. On top of this, Jim Rogers, who is a man I greatly respect, I recommend reading his books. They're all great. That he has talked about in interviews that if things get bad enough with this financial repression manipulating interest rates lower, that whereas in Japan you have people voluntarily buying the bonds. In the U.S., you may have people who don't want to buy the bonds at all, but you may have the U.S. government come up with some type of scheme to force people to buy the bonds. So say in their 401k or IRA individual retirement account or their teacher retirement account or their government employee retirement account, they may force people initially to buy 1 or 2% treasuries. It may be required by law to hold 1 or 2% treasuries. Everyone has to hold it in their retirement account, and the spin would be it's for national security, or it's to fund infrastructure. But in actuality, it's so to help the U.S. federal government so they don't have to cut their government spending, and it could help them devalue and inflate away their debt. So it's suckers. It's a captive. And if you listen to the Carmen Reinhart interview, and she starts to get really worried and sad when she talks about this stuff, that this seems to be the end game. So I will attach a link to the Carmen Reinhart interview on McIlvaney. That was almost 3 years ago. I highly recommend it. I learned a lot about how the people in power, the academics, and the people that advise the central bankers think. And I'll attach a link to the LIBOR article if you want to take a look. But we have right now, so the theory is that China can dump all their treasuries and crash the dollar, and it's just simply not true because China has been selling treasuries, but there's a lot of demand for them from a lot of these bond funds, bond index funds, pension funds here in the US, and there's a lot of foreigners that are in Europe or professional money managers in those areas that manage bond funds in those other countries, and they're looking at, on a relative basis, they are looking at US bonds and saying, hey, I can still get 2%. In this other country in Europe, I can't get anything. It's flat, the yield curve is zero or almost zero, going negative real rates. Europe and Japan right now have the majority of that $13 trillion, that astounding, remember that chart I showed you guys that was going parabolic with $13 trillion in negative real rates, negative yielding debt. And the majority of that negative yielding debt is all in Japan or the European Union. Now the US though, the path it's on, the US looks like they will eventually join them. And that chart there with the 13 trillion, when the US joins, that thing could go parabolic. It could go, much higher than $10 trillion more. It can go into the 20s, 30s. It could go a lot higher than that. So the end game could be, Ben Bernanke could have tipped his hand a while ago with the information we got out. The end game could be forcing people into U.S. Treasuries, with similar to what Carmen Reinhart said in that interview. And then on top of that, either a zero coupon bond or some other type of scheme that could potentially be worse. Maybe some type of automatic haircut. So after forcing U.S. savers into those treasury bonds, then forcing an automatic haircut maybe or something. This is hypothetical. I don't know exactly. I'm sure they're discussing these options behind the scenes. But this is the problem that we have with all these major central banks are trapped. Okay? And this goes back to Ludwig von Mises. Ludwig von Mises says once you start massive monetary inflation and credit bubbles, the only way, you have to abandon them or you're risking destroying the currency. But we have all these major central banks, the 5 or 6 largest ones, colluding with each other. They're not working with the People's Bank of China, but the Bank of Japan, the European Central Bank, the Federal Reserve, the Bank of England, probably Australia and Canada, all colluding with each other. I would not be surprised. We're not going to probably find this information out unless Australia or the US decides they need to do this for maybe PR reasons or to I'm trying to think of the right phrase here, to assuage people in Australia, that I could potentially see an announcement to the Bank of Australia that the Federal Reserve has opened up like a couple $1 trillion currency swap lines. It may have already happened. There is no transparency. We would not know if it did. And this is why in this environment, gold is going to do well. Now, silver's still at 90 to 1, but gold is doing very, very well because people are starting to see, based on what Stanley Druckenmiller has said, and Stanley Druckenmiller is one of those great macro traders and investors that a lot of people pay attention to, and he just sold all of his stocks and he's all in on U.S. Treasuries. Hopefully he owns some gold. But people are starting to research more why Stanley Druckenmiller did what he did, and they're seeing that, oh my God, the Fed could not only cut rates, but they may actually be doing rate cuts and quantitative tightening at the same time. That would be weird, wouldn't it? So eventually, though, QT will end. It's supposed to end, quantitative tightening or balance sheet reduction is supposed to end in September. Maybe they end it sooner. We could have rate cuts by the Fed and QT going at the same time. But ultimately, QT will have to end and balance sheet will have to expand. Unless they can trick more people, more bond funds, more bond index funds, more mutual funds, more pension funds into buying more treasuries. So they may be able to do that for a while, but I don't think that's going to be permanent demand for years and years where the demand for treasuries is going to keep increasing, like in Japan. Okay, so I will attach links to all of these things that I talked about. Let me make sure I didn't miss anything. Yeah, so people could eventually be forced to buy U.S. Treasuries in their retirement accounts. That's looking like it's not going to happen right away, and if it does happen, it's not going to be immediately like you have to put 40% of your retirement account into treasuries. I suspect this is just me speculating and an educated guess. They would start off small, and they would scale this thing up. Just like how with the income tax here in the United States, it started off, oh, it's only the rich people. Or, oh, it's initially it was only the rich people. Only the rich people are going to pay for the income tax, the permanent income tax. And then, oh, it's only very tiny. And then it scaled and scaled and scaled. After 1913, same year the Federal Reserve was created, the income tax got to just astronomical levels. Okay, I think I pretty much covered everything. Check, make sure I have all the articles that I talked about. Okay, yeah, I got everything. So other than that, this is going to be a short show. I think I covered pretty much everything. I'll take a look at listener questions and comments really quick. I really want to thank the $50 super chat. That is great, man. I really appreciate it. I could buy some silver. I have some options now. Yuri's Eclectic Extravaganza. That's an interesting name there. Thank you very much for the $50 super chat. Much appreciated. KT Chong says Japan has been paying a heavy price for financial repression. That's why Japanese are so depressed and not having babies, and they're going extinct. Yeah, I think there's a high suicide rate among Japanese males who hate their job, and they can't build too much savings. There's a lot of taxes there from what I hear. There's a lot of men that are not even trying to go on dating, and there's a very high, because of the cost of living in many cities in Japan. I talked about this a while ago. There's videos all over YouTube from Japanese people covering this. There's a Japanese guy with an enormous YouTube channel covering this. There's an extremely high and rapidly growing prostitution rate among Japanese women, especially Japanese college students. It's happening here in the U.S. too. It's something no one wants to talk about, but I see examples of it all the time as well. So, and if you go back through financial history, this is what happened in Berlin during the Weimar Republic, before the hyperinflation. This was happening before the hyperinflation. Berlin was becoming totally morally bankrupt. For some poor and working class German families, the very beautiful daughter, like the 18 to 26 or 27-year-old daughter, was often the highest breadwinner in the family because she was a prostitute or a showgirl. So we may be heading back to those times. I hope I'm wrong about this, but there's a lot of anecdotal evidence all over the U.S. with the sugar daddy stuff and the pay-to-play stuff, and it's looking that way. And I've heard the stuff in Japan. It's just looking that way too. So, Japanification, learn about it, learn about financial repression, learn about interest rate manipulation, and we have LIBOR going inverted now too, which is another big warning signal. 60% of the U.S.'s yield curve is now inverted, which is at a high, the highest levels prior to 1999 and 2005. So welcome to dystopia, right? If you have gold and silver, you have some cryptocurrency, some Bitcoin, and maybe a couple other cryptos, you have some cash flow rent. This is not financial advice, just my opinion. You have some rental properties that are generating you cash flow. You have maybe some prepping and some other hedges in place. Maybe you're a trader and you can trade volatility or prepare for bad stocks that are going to crash. You can make a lot of money off this. There will be opportunity in crisis, but a lot of people are not prepared at all for this. There's a lot of Americans that don't understand what's going on. They don't even know what the Federal Reserve is. They don't even know what it does. It's sad. And I've tried to have some conversations with some people and they don't want to hear it. Most people don't want to hear it. Okay, guys, well, that's it for this short little video. But the bottom line is that now, even on Bloomberg and elsewhere, they're trying to spin Japanification like it's averting national bankruptcy, when in reality, it's actually going to make things worse. It is going to destroy savers, even worse than now, and it is going to steal and pick our pocket through currency devaluation or inflation and taxes. And that is what's bad about Japanification. Okay, bye for now.